We all think about the future, don't we? And, well, predicting it is impossible, but there's one powerful way you can shape your tomorrow.
Definitely.
And that's by taking control of your retirement planning, no matter, where you stand today.
That's absolutely right. Retirement might seem like this distant shore for a lot of people,
Yeah.
but the financial decisions we make right now, even the small ones, they create the currents that, well, carry us there eventually.
And that's exactly what we're diving into today.
Mm.
Retirement plans. We're going to explore the different kinds out there, what makes them tick, and how you can start figuring out which ones might fit your journey.
Right.
We've gathered information explaining these options and also the key regulations that sort of guide everything.
It can get complicated.
It can.
Okay.
So our mission today, cut through that complexity, give you, the listener, a really clear understanding of this retirement plan landscape so you feel empowered, you know.
Yeah, empowered to make those informed choices about your own financial future. It's actually pretty interesting how the federal government really encourages this long-term saving.
Through incentives, right.
Exactly, through incentives. And also, this really significant piece of legislation, the Employee Retirement Income Security Act of 1974, ERISA. You hear that name a lot.
Right, yeah. We'll probably talk more about that.
We will. These measures, they don't just incentivize saving, they also set up important safeguards for people in these plans. And fundamentally, all these different retirement plans, they fall into two main buckets, qualified and non-qualified.
Okay, qualified versus non-qualified. Let's unpack that. What's the core difference we need to grasp?
Okay. The central difference really boils down to whether a plan meets specific federal requirements, rules set by the IRS.
IRS rules. Got it.
Qualified plans meet those standards, and because they do, they get favorable tax treatment. It's designed to encourage broad retirement
And
savings.
non-qualified.
Non-qualified plans, well, they don't meet those requirements, so they don't get the same broad tax advantages. Think of qualified plans as the government saying, hey, save for retirement, here's a tax break.
Okay.
While non-qualified plans are often more like an executive perk, without those initial widespread benefits.
So favorable tax treatment for qualified plans. What kind of treatment are we talking about exactly?
Well, for employers, the contributions they make to a qualified plan, usually a deductible business expense, that can lower their taxable income.
Okay, good for the business.
And for employees, this is key.
Yeah.
The money the employer puts in for you isn't taxed in the year it's contributed.
So you don't see it on that year's tax bill.
Right. Taxation is deferred, it's pushed off until the funds are paid out, typically in retirement, and you might be in a lower tax bracket then.
Makes sense.
Plus, that delay lets your money potentially grow faster, compounding.
Yeah, that tax deferral is huge for growth over time.
Hmm.
What if you're contributing to an individual qualified plan, like an IRA?
Well, under certain conditions, those contributions might also be tax deductible from your income in the year you make them.
Might be. So, not always.
Not always. It depends on things like your income and if you have a plan at work. But critically, the earnings within any qualified plan aren't taxed until you withdraw them later. That tax-deferred growth, that's a key advantage really across the board.
Okay, so that's the qualified side. Clear
Yeah.
benefits there. What about non-qualified again? Who usually gets these, and what's the tax deal for them?
Right, non-qualified. They don't meet those broad federal requirements for the tax breaks. So they're typically offered by employers to, let's say, highly compensated employees, executives, directors, that sort of group.
Okay.
More targeted.
Exactly. And because these plans often favor that specific group, the employer doesn't get that same immediate tax deduction on their contributions like they would with a qualified plan that covers more people. Interesting. So the tax benefits are really the major driver for qualified plans for both the company and the employee down the line. Now, you mentioned ERISA earlier, that big law from '74. How does that connect specifically with these employer-sponsored qualified plans?
ERISA, yeah, it's really the foundation. It establishes the minimum standards for most retirement plans and health plans, too, actually in the private sector. Its main goal, protect the interests of people in those plans.
So it's about worker protection.
Absolutely. And many of the rules a plan has to follow to be considered qualified by the IRS. They actually come directly from ERISA's regulations.
Okay, so if an employer wants their plan to be qualified to get those tax perks, they have to play by ERISA's rules. What are some of the key requirements under ERISA?
There are several really crucial ones. First, the plan has to be a formal written document. It can't just be a handshake deal.
Needs to be official.
Right. And that information has to be clearly communicated to all the eligible employees. Transparency is key. Also, the plan must be set up and run for the exclusive benefit of employees and their beneficiaries.
Exclusively for them, not the company's benefit.
Precisely. And the intention has to be that it's an ongoing thing, not just a temporary setup.
Got it. Formal, communicated, for the employees, and long-term. What else?
ERISA sets minimum standards for who gets to participate. Generally, if you're an employee who's at least 21 years old and you've completed 1 year of service, you have to be allowed in.
1 year of service, okay.
There's a slight exception if the plan offers 100% immediate vesting of the employer's money.
Vesting. We'll get to that, I assume.
We will, but if it vests immediately, they can require up to 2 years of service. But the point is, they can't just arbitrarily keep people out if they meet those basic age and service rules.
Fair enough. And you mentioned non-discrimination before, making sure plans don't just favor the higher-ups.
Exactly. ERISA, along with IRS rules, includes what are called minimum coverage rules. These ensure qualified plans actually benefit a broad range of employees, not just the executives.
How do they check that?
There are specific calculations, they call them coverage tests, that the IRS uses. They make sure the plan covers enough non-highly compensated employees relative to the highly compensated ones. It prevents the plan from, disproportionately favoring the top earners and who's covered or the benefits they get.
Seems important for fairness, making sure these benefits spread through the company. What about the money going into the plans? Any rules there?
Yes. For some types of qualified plans, especially defined benefit plans, pensions, basically, ERISA requires contributions to be actuarially determined.
Actuarially determined. Sounds complex.
It means financial experts have to carefully calculate how much needs to be put in now to make sure there's enough money later. They look at things like life expectancy, projected salary increases, investment growth.
So making sure the promises can be kept.
Exactly. ERISA also mandates that most qualified plans must provide for survivor benefits, usually for the spouse of a deceased employee. It adds a layer of financial security for families.
Survivor benefits, right. That's crucial. Now, what happens when someone leaves the company? That's where vesting comes in. You mentioned it earlier.
Perfect timing. Yes, vesting. It's the process where you gradually gain ownership of the funds your employer has contributed to your retirement account.
So not your own money, but the company's contribution or match.
Correct. ERISA sets minimum schedules for this. The most common are either a 5-year cliff vesting, meaning you own 0% before 5 years, then 100% after 5 years.
All at once.
Right. Or a graded schedule. Often it's something like 20% vested after 3 years, 40% after 4, and so on, until you're fully vested after 7 years. But, and this is really important, you are always 100% vested in your own contributions.
Okay, the money I put in from my paycheck is always mine.
Always. No question. It's the employer money that might take time to become fully yours if you leave before meeting the vesting schedule.
Got it. So check your plan's vesting schedule.
Absolutely. There are also rules for what they call top-heavy plans.
Top-heavy.
Yeah, a plan is considered top-heavy if the value of the benefits or accounts for key employees, think owners, certain officers, high earners, is more than 60% of the total value for all employees.
So if it's skewed towards the top.
Right. If a plan becomes top-heavy, extra requirements kick in. They have to ensure that the non-key employees receive a certain minimum level of benefits or contributions. It's another safeguard.
More checks and balances. Okay.
Yeah.
One last ERISA point you mentioned was legal segregation of plan assets. Why is that important?
Yes, this is vital. It means the money held in the retirement plan must be kept separate from the employer's general business assets, usually in a trust or custodial account.
Why separate?
It's a crucial protection for employees. It ensures that if the company runs into financial trouble or even bankruptcy, the retirement funds can't be claimed by the company's creditors. That money is protected for the employee's retirement.
Wow, okay. That's a huge reassurance, knowing the money is actually firewalled off.
It really is.
And I think I saw something about a Form 5500. What's that about?
Form 5500. That's the annual report that most employee benefit plans, including retirement plans, have to file with the Government Department of Labor, IRS.
Like a check-in.
Exactly. It provides detailed information about the plan's finances, operations, investments. It's a key part of ERISA's disclosure requirements, promoting transparency and accountability in how these plans are run.
Okay, so ERISA really sets the stage for qualified employer plans. Lots of protections built in. Now, let's get into the actual types of plans. We can start with defined contribution plans. What's the main idea there?
Defined contribution plans, the name kind of gives it away. The contribution amount is what's defined or known, at least in principle. These are primarily funded by you, the employee, usually through pre-tax payroll deductions.
Money comes out of my check before taxes.
Right. And often, the employer might choose to match a percentage of what you contribute. That's a big incentive.
The employer match, yeah. Free money.
Pretty much. The crucial thing here is that you, the employee, are generally responsible for two things: deciding how much to contribute, within plan and IRS limits, of course,
Right.
and choosing how those funds are invested from the menu of options the plan provides.
So I pick the investments.
Typically, yes. Plans offer a range of mutual funds, maybe money market funds, sometimes annuities, or even individual stocks, though that's less common. So the amount you actually have at retirement, it depends on how much goes in yours and maybe your employer's, and how well your chosen investments perform over time.
Right. So I'm in the driver's seat for contributions in investments, which also means I'm taking on the investment risk.
Exactly. The investment risk and the potential reward rests primarily with you in these plans.
What about the tax advantages? Again, specifically for defined contribution.
Same core benefit. The money you contribute grows tax-deferred until you withdraw it in retirement. The IRS sets annual limits on contributions, and those usually get adjusted for inflation. So, key takeaway. Defined contribution means tax-deferred growth, but your final balance depends on contributions and investment results. You bear the investment risk.
Okay, got it. Risk and reward are on the employee. Now, you mentioned there are three main types of defined contribution plans. Let's start with profit-sharing plans. How do those work?
Okay, profit sharing. In these plans, the employer sets aside a portion of the company's profits if there are any to distribute to eligible employees. The key phrase is portion of profits.
So contributions depend on the company doing well.
Yes,
Okay.
exactly. Employer contributions are tied to profitability. This means the employer isn't legally obligated to contribute every single year or even the same amount each year. It offers them flexibility.
Less predictable for the employee, then.
It can be. However, for the plan to keep its qualified status and get those tax benefits, the IRS says the contributions must be recurring and substantial over time. They can't just make a token contribution once every 10 years.
So some consistency is required for the tax breaks.
God.
Key takeaway. Profit sharing means flexible employer contributions tied to profits, but they aren't guaranteed every year.
Precisely.
What about getting money out early from a profit sharing plan, before retirement age?
Generally, yeah, if you pull funds out before age 59 and a half, you're likely looking at a 10% federal tax penalty. That's on top of the regular income tax you'd owe on the withdrawal amount.
Ouch. Discourages early dipping.
It does. There are some specific exceptions, hardship, disability, etc., but that 10% penalty is the general rule to keep the focus on long-term retirement saving.
Okay, so that's profit sharing. Was the second type of stock bonus plans?
Stock bonus plans. They're quite similar to profit-sharing plans in structure, but with one key difference.
Yeah.
The employer's contributions don't have to be dependent on the company making a profit that year. And importantly, the benefits are distributed to employees in the form of company stock.
Ah, so you get shares of the company you work for.
Exactly. Key takeaway. Stock bonus plans give employees actual ownership in the company as part of their retirement benefit, and the contributions aren't necessarily tied to annual profits.
Interesting. Instead of cash based on profits, it's company stock.
Mm.
It could be a way to align employee and company interests, I guess.
It can be, yeah.
And the third type was money purchase plans. How are they different?
Money purchase plans. They're still defined contribution, but they have a key distinction from profit sharing.
Which is?
The contributions are fixed. Unlike profit sharing, where contributions can vary year to year, a money purchase plan requires the employer to contribute a specific, predetermined amount each year. The plan document spells out a definite formula, usually a percentage of the employee's salary.
So more predictable contributions.
Much more predictable. The future benefit for the employee then depends on those consistent required contributions, plus whatever investment earnings they generate over time. Key takeaway. Money purchase plans mean fixed, mandatory employer contributions, providing more certainty than profit-sharing plans.
Okay, fixed contributions, more predictability going in. You also briefly mentioned employee stock ownership plans, or ESOPs.
Yeah.
How do they fit in here?
ESOPs. They're a unique kind of defined contribution plan, also designed to give employees an ownership stake.
Like stock bonus plans.
Similar goal, different mechanism. In an ESOP, the company contributes its stock, or money to buy its stock, which is then held in a trust for the employees. Shares are allocated to individual employee accounts over time.
And when do employees get the stock?
Typically, the shares stay in the trust until the employee retires or leaves the company. At that point, they can usually sell the shares back to the company or sometimes on the open market, depending on the plan rules. Key takeaway. ESOPs are specifically designed to make employees part owners, linking retirement benefits directly to the company's stock performance.
So another way to give employees skin in the game through ownership. Okay, we've covered defined contribution plans where the input is defined. Now let's flip that. Let's talk about defined benefit plans. You said these are often called pensions. What's the core idea?
Defined benefit plans, right? Pensions. Here, instead of defining the contribution, the plan establishes a definite future retirement benefit that you, the employee, will receive.
So the focus is on the payout, not the input.
Exactly. The benefit is usually calculated using a specific formula laid out in the plan. That formula typically considers factors like your salary history, often final average salary or career average, how many years you worked for the company, and sometimes your age at retirement. The focus is squarely on the output, that predictable income stream in retirement.
A predictable income stream. That sounds appealing compared to the uncertainty of defined contribution investment returns. Who takes the investment risk here?
That's the crucial difference. In a defined benefit plan, the employer guarantees the retirement benefit. They promise to pay you that calculated amount.
So the company is on the hook.
Yes. The employer bears the investment risk. They are responsible for contributing enough money and managing the plan's assets to ensure there are sufficient funds to pay out all the promised benefits, regardless of how the investments actually perform. If the investments underperform, the employer has to make up the difference.
Wow, okay. Key takeaway. Defined benefit plans offer a predictable retirement income, guaranteed by the employer, who also carries the investment risk.
That's the essence of it. A big shift in who shoulders the risk compared to defined contribution.
Definitely. What are some of the basic requirements for these defined benefit plans to get that qualified status for tax purposes?
Well, first and foremost, the plan has to provide benefits that are definitely determinable,
Meaning?
meaning the benefit amount has to be clearly calculable, either through that specific formula in the plan document or through those actuarial computations we mentioned earlier, ensuring the promised benefits can actually be funded and paid. No guesswork allowed.
Clear and calculable. Makes sense.
Second, the plan must provide for the systematic payment of these benefits over time after retirement. Usually this means payments for the rest of the retiree's life.
Like an annuity.
Exactly, often structured like a life annuity. The plan also needs to clearly spell out the conditions for receiving benefits, retirement age, years of service, etc., and any different payment options available, like maybe a lump sum option or joint and survivor options for spouses.
So it's all about that guaranteed income stream in a retirement, funded by the employer based on those careful calculations. Okay, let's move to another category. Qualified salary reduction plans. What's the main idea behind these?
Salary reduction plans. These allow you, the employee, to choose to reduce your current salary.
Voluntarily give up some pay now.
Well, yes, but instead of just giving it up, you have that amount contributed directly into a retirement plan, usually on a pre-tax basis.
Pre-tax, so it lowers my taxable income now.
Exactly. It's a salary reduction because you elect to defer receiving that portion of your income now. You trade current income for potential retirement benefits later, and that deferred amount isn't counted in your taxable income for the current year.
And the really big one in this category, the one most people have probably heard of, is the 401k plan, right? Sometimes called cash or deferred arrangements. How do they work?
Precisely. The 401k is king here. With a 401k, you typically have the option. Take your income as cash now or defer a portion of it into the 401k account. It's your choice. Participation is voluntary. The amounts you choose to defer, your contributions, they're not included in your gross income currently. So no income tax on that money right away.
And the earning.
The earnings on those deferrals also grow tax deferred until you take the money out, usually in retirement. And as we mentioned, a very common and valuable feature is the employer match.
Right, the match.
Many employers will match your contributions up to a certain percentage of your salary. That's essentially free money boosting your retirement savings. It's a huge incentive to participate.
Absolutely. Key takeaway. 401k let you contribute pre-tax, the money grows tax deferred, and you often get an employer match. Really powerful.
Extremely powerful.
What about contribution limits for 401ks? How much can you put in?
The IRS sets an annual limit on the amount employees can defer from their salary. This limit is quite substantial and gets adjusted for inflation most years.
And there's something for older workers, too.
Yes, if you're age 50 or older, there's usually an additional catch-up contribution allowed on top of the regular limit. It lets people boost their savings as they get closer to retirement age.
Good to know. Okay, 401ks are definitely a cornerstone for many people. What's the next type of salary reduction plan? 403b plans, also known as tax-sheltered annuities.
403b plans, these are very similar to 401ks in how they operate pre-tax contributions, tax-deferred growth, but they're specifically designed for employees of certain types of organizations.
Which organizations?
Primarily public schools, certain tax-exempt nonprofit organizations under Section 501c3 of the tax code. Think charities, hospitals, private schools, universities, and also some religious institutions.
So teachers, university staff, people working for charities.
Exactly. Those are the main groups you'll find using 403b plans. Key takeaway, 403bs are like 401ks, but for employees in specific nonprofit, educational, and religious sectors, offering similar tax advantages.
Got it. Sector specific. How are they usually funded? Similar to 401k.
Yes, very similar. They can be funded by employer contributions, employee contributions through payroll deductions, salary reduction, or often a combination of both. And again, those contributions are generally excluded from the employee's current taxable income.
Okay. And the last one in this salary reduction group was Section 457 deferred compensation plans. Who are these mainly for?
Section 457 plans. These are primarily available to employees of state and local governments. Think city, county, state workers. They can also be offered by some non-governmental tax-exempt organizations, though the rules can differ slightly between governmental and non-governmental 457 plans.
And they also allow deferring compensation.
Yes. Participants can defer a portion of their compensation without paying current income tax on it, provided they meet certain conditions about when and how they can access the money later.
What kinds of investments are typical in a 457 plan? Anything different?
The investment options vary by plan, similar to 401ks and 403bs. Interestingly, though, life insurance contracts and annuities are specifically mentioned as authorized investments for 457 plans, perhaps more explicitly than in other types.
Okay. And the contribution limits.
The annual deferral limits for 457 plans are generally similar to the limits for 401ks and 403bs, including catch-up contributions for those 50 and older. So, comparable savings potential. Key takeaway. Section 457 plans let state, local government, and some nonprofit employees defer pay pre-tax, with limits similar to 401ks.
All right. So that covers the major types of qualified employer-sponsored plans. Now, what about the smaller players? Small businesses, self-employed folks? Their situation seems like it might be different.
You're absolutely right. Historically, it was tougher for small business owners and self-employed individuals to get into the qualified retirement plan game. The early plans were really designed with larger companies and their employee structures in mind.
Why was it harder?
Well, often the owner was the employer and the employee, which created complexities under the old rules. It wasn't as straightforward.
But that changed, right? There was an act, the Self-Employed Individuals Retirement Act, back in '62. Sometimes called the Keogh Act.
Exactly, the Keogh Act. That was a landmark piece of legislation. It essentially leveled the playing field. It recognized that small business owners and self-employed people could act in both roles, employer contributing, employee receiving benefits for retirement plan purposes.
So it opened the door.
It absolutely did. It allowed them to participate in qualified plans.
And that led to Keogh plans, also called HR 10 plans. What should we know about those?
Keogh plans are qualified retirement plans specifically for unincorporated businesses, sole proprietorships, partnerships, and the self-employed. They allow the owner or partners to participate as employees.
But do they have to include their actual employees too?
Yes, that's a key point. If the business has eligible employees, they generally must be included in the Keogh plan too, following the same non-discrimination rules as other qualified plans.
Can Keoghs be defined contribution or defined benefit?
They can be either. You could set up a profit-sharing Keogh, a money purchase Keogh, or even a defined benefit Keogh plan. Over the years, most of the unique rules that only applied to Keoghs have kind of merged with the general rules for corporate retirement plans. Contribution limits, participation rules, non-discrimination, they're now largely aligned.
So they function pretty much like the corporate plans we already discussed.
For the most part, yes. Key takeaway. Keogh plans let the self-employed and unincorporated businesses set up qualified plans for themselves and their employees, following similar rules to corporate plans.
Okay, so Keoghs are an option. What about simplified employee pensions, or SEPs? You mentioned those are good for small businesses too?
SEPs, yes. These were specifically introduced to make things easier and less costly for small businesses wanting to offer retirement benefits. Setting up and running a traditional qualified plan, like a profit sharing or money purchase plan, involves administrative work, testing, reporting, ERISA compliance. It can be a burden, especially for a small operation.
So SAs are simpler.
They aim to be, yes, hence the name. They simplify the process considerably.
How do they actually work then? What's the structure?
With a SEP, the employer makes contributions directly into a traditional IRA that's set up and owned by each individual employee. This includes the business owner if they're self-employed.
So the employer contributes to the employee's IRA.
Exactly. The employer contributions go into the employee's SEP IRA, and they're not included in the employee's gross income for that year. A big plus for SEPs is that the contribution limits are often significantly higher than the limits for contributing to a regular traditional IRA yourself.
Higher limits, simpler setup. Sounds good. Any catches?
Well, like other qualified plans, SEPs can't discriminate. Contributions generally have to be made proportionally for all eligible employees. You can't just load up contributions for the owner or highly paid staff. Key takeaway. SEPs offer a simplified way for small businesses to contribute to employee IRAs, with potentially higher contribution limits and easier administration.
Simpler admin, higher potential contributions. Definitely sounds attractive for small businesses. What about the other one? Simple plans. That stands for Savings Incentive Match Plan for employees of small employers, right?
That's the one. Simple plans. Another option tailored for small businesses, specifically those with 100 or fewer employees who earned at least $5,000 in the prior year. And crucially, the employer can't have another qualified retirement plan already in place.
So for really small employers without an existing plan.
Right. Simple plans borrow features from 401ks and 403bs, like employee contributions and employer matching, but they're designed to be, well, simpler to set up and run, lower startup costs, less complex administration, and a big plus. Employers using a simple IRA generally don't have annual federal filing requirements like Form 5500.
No annual filing. That's a big administrative relief. How are Simples structured?
They can be set up either as a simple IRA for each employee or as a simple 401k. One really attractive feature is that all contributions, whether from the employer or the employee, are immediately 100% vested.
Wow, immediate vesting. So the money is yours right away.
Instantly. No waiting period. The contributions and earnings grow tax-deferred, just like other plans. And yes, simple plans also allow those age 50 and over to make additional catch-up contributions. Key takeaway. Simple plans offer an easy, relatively inexpensive retirement benefit for small businesses, featuring immediate vesting.
Okay, so for small businesses wanting a less complex way in, SS and Simples seem like really valuable options to check out. Now let's switch gears completely. Let's talk about plans individuals can set up for themselves, regardless of their employer. Qualified individual retirement plans. We're mainly talking IRAs here, right?
Yes, individual retirement arrangements, or IRAs. They're incredibly popular and accessible. They let individuals save for retirement and potentially get a current tax break, even if they already have a plan at work. And like the others, a huge benefit is that the money inside grows tax-deferred.
Let's start with the classic, the traditional IRA. Who can open one, and what are the rules for contributing?
Okay, traditional IRA. Generally, anyone who is under age 72 and has earned income wages, salaries, self-employment income can contribute.
Under 72, okay. What's the limit?
The maximum you can contribute each year is set by the IRS. For 2023, it was $6,500 or $7,500 if you're age 50 or older. These limits might adjust for inflation. It's also capped at 100% of your compensation for the year if that's less than the dollar limit.
What if one spouse doesn't work? Can they have an IRA?
Yes, that's where the spousal IRA comes in.
Yeah.
You can make contributions to an IRA for your non-working spouse up to the same annual limit, as long as you, the working spouse, have enough earned income to cover both contributions.
That's great. Now, the big question with traditional IRAs, are the contributions always tax deductible? You mentioned potentially earlier.
Right, potentially. It's not automatic. Your ability to deduct your traditional IRA contribution depends on two main things: your income level, specifically your modified adjusted gross income, or MGI, and whether or not you or your spouse, if married filing jointly, are covered by a retirement plan at work.
Okay, so how does that work?
If neither you nor your spouse, if applicable, are covered by a workplace plan, you can generally deduct the full amount of your contribution no matter your income.
Simple enough. But if you are covered at work,
Then the deductibility gets phased out as your MGI increases. There are specific income ranges set by the IRS each year. If your income is below the range, you get a full deduction. If it's within the range, you get a partial deduction. And if it's above the range, you can still contribute, but you can't deduct it.
Ah, so you can make non-deductible contribution.
Exactly. And even if your contribution isn't deductible, the money still grows tax deferred inside the IRA. That's a benefit regardless of deductibility.
That's a really important distinction. Deduction is one benefit, tax-deferred growth is another. What can you actually invest in within a traditional IRA?
You have a pretty wide range of options, things like flexible premium annuities, bank accounts, CDs, credit union accounts, mutual funds of all stripes, stocks, bonds, even certain types of precious metal coins. Lots of flexibility to build a portfolio that suits you.
Okay, now let's talk about taking money out. What are the rules for traditional IRAs? You mentioned required minimum distributions, RMDs.
Yes, RMDs. Because the government let you defer taxes on that money, they eventually want you to start taking it out and paying taxes on it. The Secure Act changed the starting age recently. You generally must start taking RMDs by April 1st of the year after the year you turn 73. Note, the user outline mentions 72 per Secure Act 2019, but Secure 2.0 Act changed it to 73 starting in 2023.
Age 73 now. Okay, and if you don't take the RMD?
There used to be a very steep 50% penalty. It's been reduced, but there's still a significant excise tax, currently 25%, potentially reduced to 10% if corrected quickly, on the amount you should have taken but didn't. So you definitely want to take your RMDs on time.
Good to know. What about taking money out before retirement age, say before 59 and a half?
Early withdrawals. Generally, if you take money out of a traditional IRA before age 59 and a half, the taxable portion of that withdrawal is subject to your regular income tax, plus an additional 10% federal penalty tax.
The 10% penalty again.
Right.
Are there exceptions?
Yes. Thankfully, there are several exceptions to the 10% penalty, though you'd still owe regular income tax on the withdrawal. These include things like death, becoming totally and permanently disabled, using the money for certain large unreimbursed medical expenses, paying for qualified higher education costs,
Right.
using up to $10,000 for a first-time home purchase, lifetime limit, paying health insurance premiums if you're unemployed for a certain period, or fixing excess contributions. So there are safety valves for major life events.
Definitely good to know those exist. So when you do take distributions in retirement, after 59 and a half, how are they taxed then?
Assuming your contributions were deductible, the entire distribution is taxed as ordinary income in the year you receive it.
Ordinary income, not capital gains.
Correct. If you made any non-deductible contributions over the years, then a portion of each distribution representing the return of those non-deductible contributions comes out tax-free. The earnings and the deductible contributions are taxed. You have to keep track of your non-deductible basis using IRS Form 8606.
Sounds a bit complicated if you mix deductible and non-deductible.
It can add a layer of record keeping, yes. And of course, if the IRA owner passes away, any remaining funds go to the designated beneficiaries who will then generally owe income tax as they withdraw the inherited funds.
Okay, that covers traditional IRAs pretty well. Now let's talk about the other big one, Roth IRAs. How are they fundamentally different?
Roth IRAs, they kind of flip the tax benefit around.
Yeah.
Big appeal is on the back end.
How so?
Unlike traditional IRAs, where contributions might be deductible, contributions to a Roth IRA are never tax deductible. You make them with money you've already paid taxes on after-tax dollars.
Okay, no upfront deductions. So what's the benefit?
The huge benefit is that all qualified withdrawals of your contributions and earnings in retirement are completely 100% federal income tax-free, and often state tax-free too. Key takeaway. Roth IRAs offer potentially tax-free withdrawals in retirement, but contributions are after tax. This can be really attractive if you think you might be in a higher tax bracket when you retire than you are now.
Pay taxes now at potentially lower rates, get tax-free income later when rates might be higher. Makes sense.
Are the contribution limits the same as traditional?
Yes, exactly the same annual limits.
Yeah.
$6,500 or $7,500 if 50-plus WAR for 2023, subject to inflation adjustments, and still capped at your earned income for the year.
Now, I heard there are income restrictions for Roths. Not everyone can contribute directly.
That's correct. There are income limitations. If your modified adjusted gross income, MAGI, is above certain levels set by the IRS each year, your ability to contribute the maximum amount starts to phase out, and above a higher threshold, you can't contribute directly to a Roth IRA at all.
So high-income earners might be locked out of direct contributions.
They might be, although there are strategies like the backdoor Roth IRA conversion that can sometimes allow high-income earners to get money into a Roth indirectly.
Hmm.
Also, unlike traditional IRAs where contributions stop at age 72, now 73 for RMDs, but contribution age limit was tied to old RMD age, there's no age limit for contributing to a Roth IRA as long as you have earned income. No age limit. Interesting. So what makes a withdrawal qualified so that the earnings come out tax-free?
Two main conditions generally need to be met for earnings to be withdrawn tax-free. First, you have to have held any Roth IRA for at least 5 years. This 5-year clock usually starts on January 1st of the first year you made a contribution or conversion to any Roth IRA.
5-year rule. Okay. And second.
The second, the withdrawal must be for a specific qualified reason. These are reaching age 59 and a half, or due to death or disability, or for that first-time home purchase up to the $10,000 lifetime limit.
So 5 years and one of those reasons for the earnings to be tax-free. Yeah. What if you take money out and it's not a qualified withdrawal? Say you're under 59 and a half and it's not for one of those exceptions.
That's a non-qualified withdrawal. Here's how Roths are special. Your contributions always come out first, and they are always tax-free and penalty-free because you already paid tax on them.
Ah, so I can take my contributions back anytime without tax or penalty.
Yes. That's a major flexibility advantage of Roths. Only after you've withdrawn all your contributions do you start tapping into the earnings. If you withdraw earnings non-qualifiedly, before 5 years or before 59.5 without an exception, those earnings will be subject to ordinary income tax and likely the 10% early withdrawal penalty as well.
That ordering rule contributions out first. Tax penalty-free is a really nice feature. What about RMDs? Do Roth IRAs have required minimum distributions like traditional IRAs?
Another key difference, no. Roth IRAs are not subject to RMDs for the original owner. You never have to take money out during your lifetime if you don't want to or need to.
So you can let it grow tax-free potentially forever, or at least for your entire life.
Exactly. You can leave it untouched, letting it potentially grow and compound entirely tax-free, and then pass it on to your beneficiaries. Note, beneficiaries usually do have withdrawal requirements, but not the original owner. This offers significant flexibility for retirement income planning and estate planning.
Wow. No RMDs, tax-free qualified withdrawals, contributions accessible anytime. Roths have some serious advantages, assuming you qualify, and the tax trade-off makes sense for you.
They definitely do.
We mentioned spousal IRAs briefly. Just to recap, how do they work again?
Right. Spousal IRA. It simply allows someone who is eligible to contribute to their own IRA, traditional or Roth, to also contribute to a separate IRA, traditional or Roth, for their spouse who has little or no earned income. As long as the couple files taxes jointly and the contributing spouse has enough earned income to cover both contributions up to the annual limit for each, it helps non-working spouses build retirement savings too.
Great way to save as a household. Okay, last IRA type, rollover IRAs. What's the main point of these?
Rollover IRAs aren't really a different type of IRA in terms of investment rules, but rather an IRA account specifically used to receive funds from another qualified retirement plan like an old 401k, 403b, or even another IRA.
So it's for moving retirement money around.
Precisely. The huge benefit is that doing a proper rollover allows you to move those funds without it being considered a taxable distribution. You maintain the tax-deferred, or tax-free for Roth rollovers, status. This is super common when you change jobs and want to consolidate your old employer plan money into an IRA you control.
Any limits on rollovers?
Rollover contributions are not subject to the normal annual IRA contribution limits. You can roll over large amounts. The key rule is usually timing. If you receive the money directly, an indirect rollover, you generally have only 60 days to deposit it into the rollover IRA to avoid taxes and penalties.
60 days. That's critical.
Very critical. It's often much safer and easier to do a direct rollover where the money goes straight from the old plan trustee to the new IRA trustee without you ever touching it. Direct rollovers also avoid mandatory 20% tax withholding that applies to indirect rollovers from employer plans.
Direct rollover sounds like the way to go. Can spouses roll over inherited plans?
Yes, that's another important use. A surviving spouse generally has the option to roll over inherited retirement benefits from their deceased spouse's qualified plan, or IRA, into their own rollover IRA. This allows the funds to continue growing tax advantage based on the surviving spouse's own life expectancy, which is often very beneficial.
Okay, rollovers are key for managing retirement funds when circumstances change. So we've covered a ton on retirement plans. What about saving for education? You mentioned qualified educational savings plans earlier. Let's touch on those too.
Right, shifting gears slightly, but still in the realm of tax-advantaged savings. These plans are specifically designed to help families save for education costs with their own tax perks.
First up were education IRAs, which I think are now officially called Coverdell Education Savings Accounts, or ESAs.
Exactly, Coverdell ESAs. These allow you to save money for a designated beneficiary's education expenses. And the definition of education expenses is quite broad.
Broader than just college.
Yes. Funds can be used tax-free for qualified expenses, not just for higher education, college, vocational school, but also for primary and secondary school, K-12. Think tuition, fees, books, supplies, even computer equipment.
K-12 too. Interesting. Any limits or rules?
There are contribution limits, much lower than IRAs, currently $2,000 per year per beneficiary. And there are also income phase-outs for contributors, similar to Roth IRAs. The money grows tax-deferred, and withdrawals are tax-free if used for qualified education expenses. If there's money left when the beneficiary finishes school, it generally needs to be distributed and earnings tax penalized, or rolled over to another eligible family member's Coverdell ESA before the original beneficiary turns 30.
Okay, $2 K limit, income limits, K-12 use. Key takeaway. Coverdells offer tax-free growth and withdrawals for a wide range of education costs, but with lower contribution limits.
That's a good summary.
And the other big education savers are Section 529 plans. These seem really popular for college savings.
Extremely popular, yes. 529 plans are state-sponsored investment plans specifically designed for saving for future education costs. They offer significant tax advantages.
What are the tax benefits?
Contributions aren't federally deductible, but the money grows federal income tax deferred. And most importantly, qualified withdrawals for education expenses are completely federal income tax free. Many states also offer state income tax deductions or credits for contributing to your own state's 529 plan.
Federal tax-free growth and withdrawals for qualified expenses. What counts as qualified?
It primarily covers post-secondary education, college, university, vocational school, graduate school, trade school. Qualified expenses include tuition, fees, books, supplies, equipment, room and board, if enrolled at least half-time, and even up to $10,000 per beneficiary per year for K-12 tuition now, thanks to tax law changes. Also, up to $10,000 lifetime can be used to repay student loans.
Wow, they've broadened the uses quite a bit. Are there different types of 529 plans?
Generally, yes. Two main types. First, college savings plans. These let you invest contributions in various portfolios, like mutual funds, and the value grows or shrinks based on market performance. You can use the funds at virtually any eligible college or university, public or private, nationwide, sometimes even internationally.
So, investment-based, flexible use.
Right. Second, prepaid tuition plans. These are less common now. They allow you to lock in current tuition rates at eligible in-state public colleges or universities by purchasing tuition credits or units today. The idea is to hedge against future tuition inflation at those specific schools.
Locking in tuition rates. Interesting. Key takeaway. 529 plans are powerful, tax-advantaged vehicles for college and other post-secondary savings, with investment options, savings plans, or tuition guarantees, prepaid plans.
Definitely a go-to for many families saving for higher education.
Okay, so that gives us a good overview of the qualified savings landscape for retirement and education. Just to circle back quickly to non-qualified retirement plans, which we mentioned at the very start. Remind us of the fundamental difference again.
Right, the non-qualified plans. The core difference, as we said, is they don't meet those specific IRS and ERISA requirements needed for qualified status. Therefore, they don't get the same broad tax advantages.
And who uses them typically?
Employers generally use them to provide additional or supplemental retirement benefits, often to a select group of management or highly compensated employees, key executives, directors, top performers, things like deferred compensation agreements, supplemental executive retirement plans, SRPs.
And the tax treatment for the employer.
Because these plans often discriminate in favor of the highly paid, which is disallowed in qualified plans, the employer generally cannot take an immediate tax deduction for contributions made to a non-qualified plan. They typically only get the deduction later when the benefit is actually paid out to the employee and becomes taxable income to them.
So delay deduction for the employer, targeted benefits for executives. Key takeaway. Non-qualified plans offer supplemental executive retirement benefits but lack the immediate, broad tax advantages of qualified plans.
That sums it up well.
Okay, wow. This has truly been a deep, deep dive into the sometimes confusing world of retirement plans. We've covered a lot of ground.
We certainly have, from those basic distinctions, qualified versus non-qualified.
Right, to all the employer plans, defined contribution, defined benefit, 401ks,
The
403bs,
small business options like SEPs and Simples.
and then the individual plans,
Mhm.
traditional IRAs, Roth IRAs, rollovers.
And even touching on Coverdell's and 529s for education.
It really is a diverse landscape, isn't it?
Yeah.
So many options out there, really tailored to different needs, different employment situations.
Absolutely. And hopefully understanding those core differences, qualified versus non-qualified, employer versus individual, the unique features of each type helps you start to see where you might fit in.
And remembering those tax advantages, tax deferral, potential tax-free growth with Roths, possible deductions, that's huge. Plus the ERISA protections for many employer plans we talked about. That security is important.
It's critical. So the takeaway for you, the listener, is really to start thinking. Consider your own situation. Where are you financially? What's your employment status? What are your long-term goals?
Yeah, which of these tools might align best with building the future you want?
Exactly. Maybe one or two of these plan types really sparked your interest today. We definitely encourage you to dig a little deeper into those specific ones, do some more research.
Or perhaps consider talking with a qualified financial professional, someone who can look at your personal situation and provide tailored guidance.
That's often a very wise step. These are big decisions with long-term impact. So maybe the final thought is, what kind of future are you actively building, and which of these powerful tools will you choose to help you get there?